Good morning, everyone. How are we doing, Kansas City? How are you? My name is Eric Kolchinsky, and today I will be talking to you about private credit in general. It's a new topic, it's a hot topic, and it's very hard to say a lot of specific things about it. So I'm going to try to frame it by what it is, what it isn't, what we're thinking about it. So what is private credit? This has been something that you regulators, both state level, federal level, market participants have been discussing for a couple of years now. And unfortunately, there's really no consistent definition at all about what private credit means. There's one definition that's been going around that says, oh, it's just direct lending. So according to this story, banks have had to step back from lending directly, sort of your typical C&I loans, and insurance companies have taken over that role. So all it is just direct lending. The other definition says it's anything that's not public. And in this case, when we say public, we mean registered under the 33 Act, so a security. So a lot of times I'll be talking about that, registration and public. Can everyone hear me? I just realized, okay. It means under the 33 Act registration. Now, let's see, we don't think those at capital markets, we're obviously not the last say for this, and this is mostly a research view as opposed to a view that's meant to be regulatory. So we think that those definitions really don't fit. We want to think of private credit as to why are we all talking about private credit today? Why is it a topic for a number of conferences? What's getting people excited about what private credit is? Okay. And we don't think so under that framework, under thinking about it under the what is it that's driving definition today, direct lending is not it. That's been going around for a long time. It's not broad enough to do that. And non-public, that's also been going on for a long time. Most structured finance is not public. It's been distributed under exceptions to the 33 Act. Okay, so that's the SEC legislation. So what we came up with is thinking about two things, what makes private credit today a hot topic and something that you should be thinking about. And that's two vectors, a distribution vector, that's the one that talks about the legal registration, and the transparency in terms of how much information can a person or a institutional investor get about a security. So have two dimensions, and we can talk about how those fall out. Okay, so the distribution side, as I said before, that's the legal framework of the aspect of privacy. Okay, so there's a 33 Act that was passed after the Great Depression that defines public securities. Now, in that time, there's been a number of institutional exceptions to that registration. 144A, Reg S, Reg D, that allows institutional buyers to buy securities. They're not quite public, but they're pretty darn close to it. They don't have a lot, some of the legal liability requirements, but a lot of the motions that people go through with those distributions are pretty much the same as the public side. The second exception there is the broadly syndicated loans. So let's talk a little bit about the legal status of that. Somewhere in the 90s, could be off by a bit, banks started desks in terms of syndicating loans. They originated a corporate loan and they wanted to syndicate it to other banks. So they started trading bank loans like they would other securities. But because they are loans, the courts have ruled they are not securities, so they are not subject to registration. So there's, if you look at the legal background of the 33 Act, it relies on something that needs to be a security for it to be required to be registered. Loans are not securities. So even though economically they're the same, bank loans do not require registration. So there's two types. We have now two types in this market. There's the broadly syndicated loans. Those are pretty much the information that's available on them is very similar, or the restrictions are, as the Reg D and 144A. The market's pretty liquid. You can go on the bank's website, you can look at their research, and you can see, I can buy this loan at this price. People mark the prices. It's a fairly liquid market, relatively speaking. They're not like treasuries, not like equities, but for fixed income, it's a good market. And then there's private. This is what we call true private. So these are not sold. It could be any bank loan, because remember, bank loans are not, bank loans are exempted from the Act. There's also exceptions from the Act for small distributions, where you have the buyers are fewer than a small number. So these are the true private securities. Okay, so this goes on a vector in terms of legal restrictions. So that's the distribution vector. The next one is transparency. So public securities, as you know, they're subject to reporting in the 34 Act, periodic reporting. There's a lot of information. As you know, about any company that you own equities, they're all public. You get a lot of information about the company. There's an institutional level. So let's go back. A lot of structured finance are sold to institutions. And with those, almost the same level of information is available, but you have to be, it's for a fee, or you have to subscribe, or some stuff, but you can get that information. It's available for a fee or to institutional investors. So that's the next level. From purely public, there's the institutional layer, and there's private. And these private securities, information distribution is typically limited by contract. So if you look at some of the securities that the SVO deals with, so SVO deals with a lot of private securities. The distribution of information is limited by contract. And that's to avoid registration sometimes, it's to avoid other things, but it's limited of who can see the private letter rating, who can see the financials. So it's limited information. So now we have these two vectors. And so what we've proposed, I put some of this aside, is that what we're talking about, when we talk about private credit right now, are the ones in the bottom right. Private information, private distribution. So let me quickly just kind of go through examples of what we mean. Exchange traded funds, they're registered, they're on an exchange. You can see the information in X increments. That's a debt instrument. That's public. Next, another hot topic, CLOs. So you're typically, there's the bulk of the market are what's known as broadly syndicated CLOs. They're backed by broadly syndicated loans. They are issued subject to either 144A or Reg S. Sometimes same tranche will have 2 or 3 different CUSIPs depending on what the registration was that it was issued under. Now, can you as a regulator, can I as a analyst understand what's going on? Yes. I can get the documents. I can get the monthly portfolio reports. I have to pay a fee, which is what we do. We have a vendor with Booties. We pay them a fee. We see exactly what's going on in the deal. We see the documents, both the legal documents and the monthly documents. That's all available. So that's what we talk about when we say institutional level transparency. And the last is, this is what we think private credit is. And that's truly a company, for example, let's say a typical direct lending company that the SVO would handle. Vary one or two lenders, so it's probably under a general exception to the Registration Act. And the information of both the financials and any other information is limited on who can see it. That's what we think, again, this is a topic still for discussion, is private credit. Let me stop there, see if there's any questions on this approach. Okay, all right. I know, saving it for the end. I get it. Please write them down. We're good. We're good. Okay. So let's do examples. Direct lending. I just already gave it. Basically, I have a small company. It's a family business. It's been in the business. I need money. I go to a lender who's an insurance company. They give me a loan. I don't want anybody to know what my business is doing other than the lender, maybe the SVO, maybe a single rating agency. So we sign confidentiality agreements that it's not going to be distributed outside of that. That's very simple. Unfortunately, that's not where the action is. So these are some of the feeder funds. That's an example. So these are now more structured, more complex types of private credit. So basically, I have a fund that invests in private equity. I buy private equity limited partnership interests. What I do is, and then I take, I sell the top of the fund as a note. And there's legal agreements that any cash flow that comes in from this limited partnership interest gets to pay down the note. That's truly private. For instance, in most cases, we don't know what's in the fund. We don't know what any of the LPs are holding. We get some marks, but those are not, they're usually, those marks are typically done by the investment manager. These are not tradable securities. So it's truly, truly private. These are mostly done via private letter rating. And it's very hard to both get information about this as well as, to sell it. There's just no information about it. So this is an example of structure. I have a couple of master funds that are all the way on the left. The feeder fund buys them. Okay, it sells a senior rated note, which is bought by an insurance company. Okay, so the issue here is one of the things about this is that the investment criteria characteristics here, because we don't know what's underneath, it could be pretty much anything. They're usually valued in terms of rating agency based on prior returns, but those prior returns don't really talk about when the timing of the money that comes in. So the returns can be volatile. There could be other things, liquidity providers that are around it to ensure that liquidity comes in, but that's the basic form. Okay. Private credit, some other examples. Private credit CLOs, we've seen a lot of those. So in the past, the market had two types of main corporate CLOs. There's the broadly syndicated. I mentioned where I can go in and I can see exactly what's in the CLO's portfolio. I can, if I wanted to, I can re-underwrite each company in there because the company information was there. And then there was a smaller group called middle market CLOs. And in the middle market CLO, I can look at the structure, I can look at the reports, I just don't have the names of the underlying portfolio. So remember, a CLO is backed by a portfolio of corporate loans to single B companies. And in a broadly syndicated CLO, I see the whole portfolio. In a middle market CLO, I often just see numbers and credit estimates by a rating agency. But I see the structure of CLO. I see the machinery of the CLO as it turns, it pays, how much money is it generating. I just don't see the underlying company names. Now we have a new type of CLO called just private credit CLOs, and those we can't even see that. We don't have a lot of information. A lot of those are sold to a single insurance company or a group of insurance companies. So we don't really see we don't see the machinery or the underlying portfolios. That's still a very small part of the market. The middle market CLOs are still a very small part of the market. We think about between 10, 20% in terms of insurance holdings. These are even smaller than that. Asset-backed financing. Most asset-backed financing is now, as we said, institutional level, so 144A, but it's increasingly moving into the private credit space. Not sure why that is, but that's where it's moving. So and we're talking about here RMBS, we're talking about freight car financing, any kind of receivables financing, just moving into that space. Any questions so far? I am awesome. Wow, I've answered all your questions. Okay, all right. All right, so how big is private credit? That is the big question, and the problem with that question is we don't have a definition of what falls into private credit. And one of the issues that we have is, I'll give you an example where we don't think as regulators or staff is private credit. There's some work that's happening on this issue at the international level. And one of the assets that those folks want to bring in is commercial mortgage loans as private credit. And we disagree. Technically, commercial mortgage loans, you would say, probably meets a direct lending criteria, right? You're lending to a borrower. It's a one-on-one relationship. There's very low information. You can't get the legal documents on a website and look at them like you could with some of these other things. But obviously, commercial mortgage credit in the U.S., especially for insurance companies, has been if not a core asset for a very long time. Commercial real estate data is available in the U.S. is highly available. There's companies whose sole business is providing commercial mortgage information. So from our view, commercial mortgages are not private credit in the sense that we are concerned about today. So most measures of the size of the market that are coming from the U.S. side will exclude that. Most of them come up into the between the $1 and $2 trillion range, and it's growing. As you can see, this chart that I have here is from a Moody's report of where they see private credit going. I've looked at other attempts to measure the market. They all sort of fall into this range. Some market participants I've seen looking at the potential, and this is mostly they're trying to sell their business, so don't take this number with a grain of salt. I've discussed a potential market in the $40 trillion range. I think that's clearly somebody's trying to sell their business, and potential for growth in the business. But I think the 1 to 2 trillion, maybe a little bit more, is the right number. Excuse me. Okay, let's talk a little bit. Why does someone want to buy private credit? The yield. That's the number one reason. It's probably between 100 and 200 basis points of extra yield on private credit. You could end it right there, right? And just say that's it. But there's some other reasons. So it's a stable investment. Now we'll talk a little bit more on the risks of that issue, but it's a stable investment. It's probably level 3 for purposes of, I think, still used GAAP accounting. Is that still used? Yeah. So level 3. Very few people know, I would say even past that. So a lot of if you think back in the financial crisis, a lot of securities we had level 3 on were the institutional investments, where you could at least see the underlying mechanism or what was underneath in the pool. These are not something that anyone can see. So they're in that same level 3 framework, but no one else can see what the machinery is, what's inside the box, okay? So they tend not to be marked a lot. And last one is borrower management. Now this is also something that can cut both ways, and we'll discuss it in the next slide. But one of the reasons that commercial mortgage investments by insurance companies tend to do so well is the insurance company has the ability, if there is a hiccup, to say, look, let's renegotiate. It's just me and you. Let's sit down, see what you can do, what we can do. Let's get through this and maybe wait for a bump in the cycle so we can all win in this investment. And that does work. Not always, but it does work. So this borrower management, you have a one-to-one relationship, and if there's a hiccup, you can talk to the borrower and say, what can we do? How can we manage through this problem if there's an issue here? So that's also, again, as you probably can think that there's can be downsides to that, but that's definitely can be a positive. Questions? Okay, risks. Oh, there's a question. Yes. Oh, yes. I do not know you at all, right, sir? No. Yeah. Hey. And the card that you're holding is an ace. No. Okay.
No. So when you were talking about not knowing what's underneath, especially with the feeder funds, does that include? I assume you talk about analysts, but does that also include the note holders?
I think you would typically assume that the note holders have some information, but that's excellent question, sir. Who I do not know, have never met before.
Sure.
Yes. So the question is, the note holders do know, but the distribution beyond the note holders can be very limited. So for a broadly syndicated CLO, if I do not own the note and I want to know how the CLO is doing, so I can just buy the software, and buy the data feed and analyze it. And here I have to have some sort of a legal framework for me to get that information and to analyze it. On top of that, I may know what's at the first level. I may not have the financials at the second level. So it's in a feeder fund. I may know what funds are being held by the fund. I don't know what's inside that fund. So there might be layers of transparency.
Okay.
Thank you, sir, for a person I do not know. Any other people who do not know have excellent questions to ask me? Okay. All right. So let's talk about what are the risks of private credit. Well, the first one, there's no market consensus. There's a reason we have a market, and the market is people get together, and some people say, I have a financial stake in this, and I don't like this. I don't want to buy this, or I'll offer it to you at this price. That's how we come up with prices of things. There's no such thing here. It's direct lending, and that's part of it is that one person to one person, and you agree on the terms. So if the hazard here, if those two people are not motivated, it's not an arm's length transaction, you may get bad terms or terms that favor one side more than the other. Opacity. And this is a personal thing. We, at the Capital Markets Bureau, at the SEC in general, sometimes we go on information hunts. Can we find this security somewhere? You know, it's not like, you know, typing up, okay, this is this security, I know what's inside. This is this company, here are the financials. No, you have to go on an information hunt, and it's very difficult to say. Sometimes there's secondary statement somewhere on a rating agency website where you can find a glimpse of information, a ratings letter. All you know is, for example, this has happened before. We have a name. The name tells you nothing about what's inside. Could be a place name, Greenfields LLC. Okay, great. Greenfields with Poppy Flowers LLC. Beautiful, very content picture. What's inside? What does it do? What is it? Can't find. Maybe you can find a rating letter that says, I assigned this rating to Greenfields with Poppies LLC under this methodology. So rating agents now have to say what methodology they used. Aha, it's a it's a waste disposal company. Okay, Greenfields, right? Got it. I kind of know what it is, but it's just difficult to get information. And we've done this, I think all of us in New York have done this a lot with just names that some of you have asked us to research. Okay, so weak credit signal. This is the flip side of the stability. This is called kicking the can down the road. If I have a one-to-one relationship, and it's especially a very complex investment, how do I know when it's underperforming? You know, a lot of securities have pay-in-kind provisions. Means that instead of paying cash interest, they pay and accreting the principal. What kind of credit signal? So for me as a credit analyst, I want to see credit signals. Something that tells me that you've gone from normal performance to I'm in trouble. And that's what we call a credit signal. When you have lack of opacity, you don't know if something's performing. If you are able to kick the can down the road, or you're paying kind, I just don't know how this asset is performing. And this is true from a regulatory basis. This is true of an agency from a company. You know, we saw this in the financial crisis, where the company was fooled by what a few of the bankers were doing in terms of, you know, how they placed a security in their balance sheet. So it's a very weak credit signal. And the last is lack of liquidity. Because the information and the distribution is limited, it's private. There's no, you know, part of the reason that you do a public registration as a company is that anybody can buy it. You do that once, anybody can go in, you know, you can set up a brokerage account, go in and buy a stock. Done. I, as the company or as the holder, I don't have to worry about what you are, what you do is I can just put it in, buy it, sell it. Reg D is a little bit more difficult. You know, you got to ensure that the buyer meets certain criteria. But in institutional space, it's pretty easy. Here, I have to see, can I distribute this? And on the other side, if you are a buyer, you can think of this, let's think of this as a sort of a fire sale type situation. If I'm a buyer, I need to sell my pool of private credit. I have some time. I have to provide us all this information. Some information is not available, so I may have to go to the company, get them to sign waivers. The liquidity here is pretty low. Okay, so it's not something that you can sell fairly quickly. Okay, questions? George, person I do not know. No question? Okay. What? It just came to me. and you live in New York. Sorry, I always kill the joke. That's my thing. Okay. What? Got an online question? Yes. Online person is going to sound an awfully like Dan.
Yeah. So establishing a private credit definition is also a big project at the international level. Is this approach potentially suitable for that as well? How is the U.S. unique in terms of private credit?
So the question is something that they're doing at the international level. Is this approach, I guess, can this be used at the international level? And is the U.S. unique? I think the answer is mostly yes. I think at the international level, you don't have, and when we generally say international, we mean Europe, some parts of East Asia. The legal distribution requirements do differ. One of the things that makes us a very powerful market is that it's broad, and we have one single legal definition of how to distribute securities. So I don't know if I can, that layer of distribution that goes by that vector of the definition that goes by the distribution, I'm not sure that's completely completely, you know the word. What? Equivalent, thank you. Also a person I do not know, thank you, Good Samaritan. But the transparency issue is, can you find information? That's a really practical question. Who is able to hold information? Where is the information available? I think U.S. is unique because we do have this broad legal framework. And we do try, for the most part, the focus, until really this private credit push, the focus has been on making more information publicly available, or at least institutionally available. And you can find information pretty much on anything, on mortgage investments, on commercial properties, on catastrophic risk. There's always a place, and there's been businesses that have been built on adding information. So we have that infrastructure in the U.S. So I think it can be expanded to the international sphere. I think each of the markets will have to look at their distribution requirements. I think in the EU, hopefully it's consistent, but yeah. Another question.
Another question. Do private placement bonds with 144, I think the question is, easily liquidate?
Yeah, mostly, yes. So the question was, do 144A bonds, yes. So it depends on the market, it depends on the time, but let's say you're a company, so let's go back to our example of CLOs or CMBS or RMBS. Mostly 144A, these are institutional securities. RMBS and CMBS tended to be public before the crisis. They've tended to gone into the institutional space recently. But yeah, if you call and say, I want to sell, especially at the AAA level, that has to be active market, I want to sell this security, it's a 144A, I give you the QSIP on the other side, either at a bank or an institution. I punch in that QSIP, I have the numbers, maybe I have a day to refresh the numbers, but yeah, it can be fairly liquid. It's not as liquid as I need to sell the stock or a treasury, but in terms of the ability to sell, yeah. There's other factors, so that the AAAs tend to the top of the capital structure. It will be sold easier than somewhere in the mezzanine, but nevertheless, it's not that bad. Okay. Regulatory treatment. Because the definition is vague and you have different types of securities in this, there's really it's asset by asset. There's no specific private credit regulatory treatment. It can take many forms. we talked about feeder funds, it could be anything. The accounting treatment follows the form. And in reporting, they're very difficult to find. So if you would like, if you're a regulator, we have a capital markets has a report that's regulator only, where we try to take a number by looking at things that kind of would have the indicia of a private credit. So things with private placement numbers. Private placement number is an analog to the QSIP, but it's issued by the same bureau, but it's essentially for private securities. It's a unique number for private securities. What distinguishes it, it usually has some sort of a character like a dollar sign, a pound sign. It looks kind of like a QSIP, but it has usually in the middle, it has a sort of a non-standard character. So we looked for private placement numbers. We're also looking for private letter rating securities, so the ones that will file with a PLR, and we have a report. So if you're a regulator, feel free. I think it's on StateNet. And if not, if you can't find it, please reach out to me. Sir.
So when you're purchasing these investments, do the investor have a lot of information about what's in them? Or is it some situations where they have an idea of how it functions, but they may not necessarily see essentially what goes into the sausage when they invest in this? So and then beyond that, are these typically stable? Like once the fund's created, do they, say you do all your due diligence, is it then going to morph into something else in 3 to 4 years, and unless you're paying attention, you just don't know it? So I'm wondering, like, I know they're very variable in terms of like their structure, so maybe there's not a good answer to that, but that's kind of what I'm wondering.
I think, so on the first question, do the buyers should, and I think that's part of the regulatory, one of the things that regulators can do, if not offer an opinion, is look at what are the underwriting standards of an insurance company for these securities. So if security is, a PLR, PPN, what is your underwriting process? What information are you requesting? What information are you maintaining on a regular basis? How are you looking at the performance? Who marks the securities? Who analyzes? What's your analyst to credit ratio? That's one of the ways. How many credits is each analyst on your team following? Are you outsourcing it? If you're outsourcing it, how are you monitoring that? So those are great due diligence questions, because you should, the more private the security, generally, the more information you need to have a great underwriting opinion. So that's one of the things that regulators can do, is to look at the procedures, and if they're being followed, review underwriting files and look at what's done. And the second question was how stable these are. It depends on the security. It depends. If it's a direct lending investment, it's just like a company. They may decide to go from, turn around and they're selling widgets today, and then they're making toilets tomorrow. But that's going to be in the financials, and hopefully you'll see that. It's not easy. Some of these funds are revolving, so the portfolio can change. So yes, you have to have infrastructure as a holder to not just do due diligence at the front end, but maintain an oversight of the information you're getting. That's also extremely important. Because remember, we talked about the risk. There's a very weak credit signal. So you really have to make sure you're seeing that, okay, here it is. Something's going wrong here. I expected, expectation that this company will pick for 3 years. It's been picking for 5. Is it picking because it's experiencing a lot of growth and it just needs that operational income to build, or it just can't pay its bills? So, yeah. Thank you. So, okay, yeah, on the reporting side. Okay, conclusion, it's a hot new product. There's conferences, everybody's talking about private credit. I think what piqued my interest a few years back is I went to a typical structured finance conference, which generally deals with CLOs, RMBS, and things like that. It was all about private credit. And then they eventually rolled that off into a separate conference just for private credit. So for structured finance. So there's no definition, but really think about restricted distribution, restricted information. So those are the commonalities of private credit. And again, you get a higher yield for sure, but the lack of information, the opacity, and the lack of liquidity comes along with it. So those concludes my final remarks. And sorry, let me, sir. Well, I do know her. Oh, sorry.
On Monday at the AM Best presentation, which was the last presentation of the day, they had a chart that showed the percentage of bonds, public-private a few years ago, and then the current percentage of bonds, public-private. Clearly the distinction was greater, but then they also made the comment that they thought that it was basically done. Like what we saw today as the percentage of private was it was done growing. And I'm curious as to your thoughts on whether we've hit the top level of the investment of this, or do you see this continuing to grow?
I see it continuing to go up. This is a chart, and it's hard to see. I believe that's 28 estimated. This is from Moody's, so from their report. Let me see. Maybe the explosive growth phase, the first derivative of it has sort of plateaued, but I still see it growing. Maybe slower than before, but yeah. Oh, wait, hold on a second.
So I get lost with trillions. How close are we now to where residential mortgage loans were in 2008?
Oh, wow.
Are we scale equivalent?
So there's two questions. I think, okay, so there's two questions here, and if I may, first question is, are we scale equivalent to mortgage loans? Close, not quite yet, I think. I'm trying to remember what the exposure was. But even more important, there's one other, again, this is Eric's opinion. There's one other aspect that existed pre-financial crisis that I have not seen here. The issue with the financial crisis, and one of the benefits here, is a lot of the things that went wrong were mark to market. And it was, so think about AIG, FP, and the credit default swaps. They had posting requirements. So what got AIG in trouble is they had to post, and there was a constant negotiation between Goldman or other banks. They wanted cash to post on a mark-to-market basis. Same with a lot of the RMBS that we got in trouble. They were either held into at banks on at their available for sale book, which means that they were mark-to-market book, or they were done. They were on a repo basis. They were level 3, but again, these were public securities, so they were constantly mark-to-market. So part of the shift away into the privates is to get away from that snowball effect. And as they say, generals keep fighting the last war. So that I'm also not, I keep looking for that mark-to-market. I have not found it. So the scale, even if it gets the same, I think the risk is not a catastrophic collapse, and it could be wrong. But the risk is a slow, companies just don't come out of the pick. Maybe sort of a 90s type Japan situation. I don't see so the size is, even if it gets there, I don't see that, at least Eric's opinion.
So speaking of PICs, can
Yes.
you discuss payment in kind a little bit more and why there's such a relationship on privates with using PIC?
So payment in kind. So the payment in kind mechanism is something that you do theoretically. What's the economic rationale for allowing a payment in kind? Well, I think better days are coming, but not today. And so we all agree that I'll allow you to pay me in kind, which means I'm going to accrete the interest, right? So as interest is an amazing credit signal, right? Every periodically you hand over cash. You have to have that cash available to hand over, right? It's an amazing credit signal. One of the great reasons for fixed income being a good tool for analysis, because periodically somebody has to have cash. So why would you allow somebody to get rid of that credit signal? So I'll give you, I don't know what's the most common, so let me give you some of the good sides and the bad sides. So on the good side, I am a company in its growth phase. I just invested in a company that's doing AI. I'm building data centers. I need every penny to build these data centers because it's a growing company. I don't want to turn away any customers. I'm building left and right. If I have a penny that's coming in, I'm putting it back in building. So that's sort of the good thing. That's a company growth phase. And afterwards, I'm just going to be raking in money. So I'll pay you, even if it's double or triple, I'll pay you back. Because usually what happens is when you pick, it's accreted. So you're paying interest on the accreted amount as well. So it sort of builds up compound interest. Or I'm in restructuring. That's another, company that's in restructuring. We had bad management. They kind of threw the company away. I brought new people in. I brought in with new capital, and they're really working very hard to rebuild the company, rebuild the distribution channels. But that money that just came in as new equity money should be better spent on some of these things. So those are the good reasons. Some of the bad or neutral reasons is, for example, the feeder fund structure, right? If the underlying are limited partnership interests in private equity, those private equity funds don't have a regular payment. So most structured finance securities are built on the idea that underneath is a pool of assets generate regular payments that I collect and then I pay you. This is not. So maybe I can sell something. And so I can, one of the things I can do as a manager, if I don't have a regular interest stream, I can sell some of the interests, and then those interests use the proceeds to pay interest. So you know what? If I sell it today, it's not worth it. Let me just hold on. I know who's going to pay. It's just a timing issue, so let me pick. That's a neutral credit signal. As we said, sometimes a pick, sometimes you want to go on. Other times, in the case of CLOs, everything, all the tranches can pick. And that, it can right-size the deal as well. So in CLOs, it's not necessarily bad, but what happens when tranches pick sometimes is interest is used to pay down the more senior notes. So you're right-sizing the deal, and a lot of times in the past several crises, they've come out of it. Tranches have gone to pick and then to pay back. CDOs, the financial crisis things, they picked, they never came back. So in terms of why would I enter into day one? It's usually, hopefully, that you're seeing a company that can get out of a situation or has growth.
I've got another one online here. Can you talk about regulatory initiatives already complete or in process that would address some of the concerns that you've addressed or that you've raised? I know the accounting presentation earlier talked about an exposure SAP working group for additional reporting, Schedule D reporting, but what about the PLR rationale?
The PLR, we're working on the PLR rationale report.
Could you discuss each of those?
Sure. So this is, has been an effort by the SVO to require rationale reports for private letter ratings. So a lot of times when I was at a rating agency, so give me a sec, I think I'm on flashing a red light here, the red light of death. A rating letter said, we're assigned this rating to this tranche, and that's it. And there was what we're looking for these PLRs are what are no pre-sales or new issue reports, is discussion, why did you assign this rating to this security? And those are some things that rating agencies do. They discuss, okay, we use this methodology. Here's what we assumed for cash. Here's what we assumed for growth. And this is what we assumed for expenses. And this is how we got a rating. So that's something that the SBO has been working on really diligently to get the rating agencies to understand how they were able to get from point A to point B. What was the method, what was the thought process? And that's the PLR. There's also a discretion proposal that's been approved. And that's where if there's a 3-notch difference, I believe, that the SVO can say, okay, let us take a look at this. If we think this is a single B credit and you're giving a triple B, there might be something off. Let's take a look. So that's discretion proposal. Yeah.
One more if there's time.
Okay, I'll take it.
And that's related to liquidity stress testing. Any
Yes.
company that's subjecting themselves to a liquidity stress test, should private credit be considered an available asset under a stress test? Or if so, should it have to take a haircut?
I mean, generally, we can't really direct companies to what they consider, but I think it would be, the general sense no, but if they do insist, that it has to be a good rationale on why or how. I can't think of a truly private credit where information is not available, that can be easily sold in a stress scenario. So. Thank you.